Morning, everyone. Tim Nyland here. Today is Wednesday, April 21st, and this is our weekly strategy call for Zacks Professional Services, where we analyze stocks, question the typical narratives, and discuss all things moving the market. Before we get started, hit the subscribe button and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you have a topic you want me to discuss in a future video, leave me a comment below. And if you find this video useful, be sure to hit that like button. This week, we're going to take a look at homebuilders and specifically the valuation paradox that I'm seeing with homebuilder stocks. Effectively, extremely low PE valuations in the face of what we're seeing as extremely high demand and extremely low inventory for housing. And this particular webinar was prompted by several inquiries that I've had from not only advisors, but also from two portfolio managers, to be specific, as to what's going on in the home builder space. So I also noticed that there has been a lot that's been written about the home builders recently, and I came across this excellent article in the Wall Street Journal that I'm sharing with you that talks about the extreme nature of this housing shortage. And so we are going to dive into some of the demand side issues, some of the supply side issues, but I'm going to uncover a really, really strong fundamental driver that is basically holding back the PE multiple expansion for the home builders here towards the end, that I think you'll be shocked when you see what's really going on in this space. So again, trying to uncover topics here that aren't necessarily being discussed in the media, and certainly you won't be reading about them in the Wall Street Journal. So hope you enjoy this webinar, and as always, the slide deck is available. All you need to do is email me or email our award-winning support. We'll get you all of those email addresses here at the end of the webinar. So let's go ahead and get started. And I'm going to start out as I normally do. If you haven't seen my webinars before, you'll quickly realize that I use this price and earnings chart out of the Zacks Research System as more or less my analytical homepage, if you will, or my compass. And we're going to start out by taking a look at some of the larger cap stocks in the home building industry, if you will. And the first one we're going to look at is DR Horton. I've got a lot of colored boxes up here. It's really easy to follow this. All we're doing is we're comparing the price here in blue relative to the trailing 4 quarters adjusted earnings line here in orange. And what I want everybody to see is that we're dealing with 3 very distinctly different time periods for the home builders. And so we're going to look at 4 home builder stocks right now. I'm going to show you these similarities. And what I want you to notice is that in this red box, in this Great Recession area, we actually had a PE multiple expansion that was quite substantial for home builders coming out of the Great Recession. And we know it's a PE multiple expansion because we can see this blue line trading above the orange line. And notice that I've got the earnings per share again lagged by 1 year. We scale earnings by a factor of 10 to give them a scaling perspective or context relative to price. When the blue line and the orange line cross one another, the stock is effectively trading at a forward PE multiple of 10 times. So it gives you a nice context for a PE multiple expansion or contraction. And so what I want everybody to see is that during this red box era, if you will, we traded in terms of price, the blue line above the orange line, which means we're trading in excess of a PE multiple of 10. You can see we almost touched a 10 here, and then you can see multiple expansion. So we actually got a bid to growth valuation here. And then you can see over time, as we get to 2016, we collapse. And then ever since then, we've been hugging the price line, if you will, or I should say the price line has been hugging the earnings line. And as a matter of fact, since literally 2018, we've been trading well below a PE multiple of 10 on a year forward basis for DR Horton. You can see the price line actually trading below the earnings line, even though we've had this massive run up in earnings growth. We saw this same exact phenomenon from 1996 to 2005, right before the Great Recession. So we saw a price for DR Horton that literally walked the earnings line and then fell below the earnings line. So we're trading well below a PE multiple of 10 for DR Horton. Despite this massive run-up in growth, the buy side was still not confident in management's ability to continue to deliver on growth in anticipation of some sort of a rollover, which we ended up getting here in 2005. And you can see that we had this massive valuation reset along with earnings. So we're currently trading in along those same conditions that existed back here during pre-Great Recession. I want everybody to see these three distinct time periods. And also just always pay attention to these consensus estimates. Massive growth, we know about 47% to 22, going down to 12%, 23 showing as flat for DR Horton, but with only 10 analysts. So we go from 21, 20 down to 10. So always keep that FY3 number with a grain of salt. It's pretty much the same. You want to do that with any consensus provider, not just Zacks. So next stock we're going to look at is Lennar. We'll speed this up a little bit. You'll see the exact same trend taking place here. We get a nice PE multiple expansion out of the recession. We end up getting a valuation catch up, PE multiple collapse in 2016 down to that 10 multiple. And then in 18, we actually trade below. This is exactly the same thing we saw with DR Horton, the exact same scenario we saw with DR Horton here from 1995 to 2005. Similar growth forecast here as well, 42% to basically flat. Pulte Homes, again, keep in mind, earnings lagged, same exact scenario. PE multiple expansion, collapse in 2016. We've got PEs trading below 10 now. You can see my PE F1, F2 here, 8.68 on the price and earnings chart. And obviously you can see that 1996 to 2005 time period. If you're seeing a trend, that's the whole point of this. I want you to see this trend. We're even going to take a look at the luxury side with Toll Brothers, and you can see another familiar scenario playing out. Massive PE multiple expansion here. You can see this valuation catch up. Price actually sits flat. Again, we've seen this before. Earnings catch up to a PE multiple collapse. You can see the blue line collapsing into the orange line, eventually a PE multiple of 10, and then we obviously trade and we walk the earnings line, okay? So the idea here is we can use the research system to go in and actually look at composites by their category. And so if you click on this magnifying glass, this is obviously for research system users. This is important. I just want to take a quick aside here. Go into the universe list as, pull the list control down, go to the Zacks composites by category. From there, you can get at all the sector, industry, sub-industry composites. And all I did was grab this residential and commercial construction, or I should say, it's more or less the homebuilders sub-industry. So I went ahead and clicked on that, and now we're looking at a 20 stock market weighted composite of the homebuilder sub-industry. And you can see the exact same scenario, okay? So this isn't just an issue that's related to those four stocks we just looked at. This is the exact same scenario we see playing out for the entire industry, okay? Multiple expansion here coming out of the Great Recession. We get a flat line in price from 2013 to 2016. We get a valuation catch up, PE multiple collapse to 10 on a year forward basis. Keep in mind, EPS still lagged a year. And you can see that we're trading at sub PE 10 multiples here on year forward earnings. F1 is actually 10, F2 9.3, F3 7.7, but you can see it's trending below the earnings line. Same scenario we saw back here from 1995 to 2005. So the idea is, what is going on, right? When we look at this chart, I'll take you back. When we look at this chart, we've got such high demand for housing. We've got such low inventory. Why are we not getting a similar PE multiple expansion that we were getting coming out of the Great Recession? Why are we actually trading as a group, in most cases, below the earnings line, if not just hugging and walking that earnings line? Why aren't we getting this PE multiple expansion that we got out of the Great Recession? So we're going to dive into this, okay? The article that I showed on the screen does a really, really nice job of outlining some of the demand and supply side arguments for the home builders. And I'm going to basically convert that into support for either higher or lower PE ratios. And so if we look at the housing shortage, right, Freddie Mac is estimating the U.S. housing market is more or less 3.8 million units short to meet current demand. We know that demand is rising relative to supply. And as a matter of fact, in the article, that Freddie Mac estimate is a 52% increase in the nation's home shortage versus their same read in 2018. So that's a massive increase. Housing prices are on the rise as a result, and it's certainly making it difficult for first-time home buyers to enter the market. The demand is so strong, home builders would need to construct 1.2 million homes per year to meet the demand, and that still would not shrink the existing deficit. 2020 single-family housing starts rose to 991,000 units, and that's the highest rate since 2007, and that's just massive demand. Demand is so strong right now, the home builders are pacing their sales to ensure they don't sell any more than they can build. So let's look at the supply side, right? The supply side housing economics actually support lower PE ratios for home builders, right? We have a labor shortage that's basically a hangover from the Great Recession. So we've got a construction labor pool that shrunk in the Great Recession as basically the home builders went out of business, and that still really hasn't recovered. And then we've coupled that labor shortage with a labor shortage due to COVID. We all know how many workers have left the workforce and not come back. There's also a material shortage, right? So lumber mills and metal foundries were operating at fractional capacity during COVID. Now they're actually struggling to keep up with demand for raw materials. We all know that's going on. We've all heard about material costs. I'm going to show you a chart here in just a minute, but the demand for materials has obviously pushed commodity prices up. It's certainly adding to cost pressures for housing. We've also got a developed land shortage, right? So raw land is ample in supply right now, but it takes time to develop the land with the streets, the sewer, the utilities to get ready for that new home construction. So let's take a look at the costs. And what I'm going to use as advisor tools right now, under the fundamental charting area, we got some really nice charts. Just literally all you have to do is, in this case, all I did was just type lumber. And the IntelliSense actually gave me, a lot of different lumber options to choose from. And I just went straight to the producer price index. I like using producer price index information out of advisor tools and converting it to a 1-year percent change series so you can see the data format. I don't use the raw data. I don't look at performance. I look at 1-year percent change. Again, when we're looking at impacts on PE multiples and valuations, it's always the shock value of a 1-year percent change that tends to have the most correlation. And when I'm looking at prices, I want to look at price change. When you look at these index values like any other index, they're literally just a positive linear straight line, and they're really of no use until you transform them. So you'll see that option in advisor tools. I suggest you use it. And you can see that the 1-year percent price increase for lumber, in this case, I actually chose 2 producer price index numbers. I chose lumber and plywood. And you can see that these are the highest 1-year percentage price increases we've seen literally in the last 20 years, even greater than the Great Recession. And this is obviously the #1 commodity cost for new home construction. So it's definitely an issue. Same thing with copper. Grabbed 2 series out of copper, literally just typed in copper, and the IntelliSense returned back a ton of different series I could choose from the producer price index. And I just grabbed pipe and wire, and you can see that we're right about equivalent with Great Recession recovery. And so if we put this together and add in the interest rate factor, it's here in lime green, a little bit tough to see, but nonetheless, you can get the idea that we've just catapulted. Now keep in mind, interest rates obviously still at decade lows. So, but the fact that we've had such a massive run up in treasury yields has definitely impacted the housing market. Certainly the refinance industry as well. So anyway, all costs have skyrocketed. But again, what I want everyone to take away from this is really not the real story. The real story is that builders have been able to pass these costs off onto the consumers, and we're going to look at the impacts of this. So as portfolio managers, how do we know that builders have been successful at passing these costs off, right? What we have to do is we have to look towards the financial statements. I know this is something that nobody wants to do, and I don't like doing it either, but I've got years of experience doing it. I have a better way for you to do it. Instead of actually diving into the financial statements, which you can certainly do, we have the ability to transform these financial statements, look at everything relative to revenues. I've outlined 4 different line items to pay specific attention to. And it all has to do with margins and what goes into those margins, right? So gross profit is basically your revenues minus cost of goods sold. So we're going to look at gross margins. We're going to look at EBIT margins, which then further take into account SG&A, R&D, and depreciation and amortization. EBIT is my favorite margin measure. It's literally your operating margin. It's one of the most important. And then obviously we're going to look at how those revenues coming into the income statement distill down into your EPS, what we call our adjusted EPS or before non-recurring items. This is going to be obviously your net margin, okay? So I prefer to use the charts, and using the charts is just as valuable as actually analyzing the financial statements because I know what financial line items take place in between each of these. So I literally just took an entire income statement and transformed it into a chart. Keep in mind that on the very top panel here, I have a revenue chart and I transformed that to a 1-year percent change. You need to look at revenues as a 1-year percent change because it is a growth series, okay? If you look at this in raw form, it's just going to be a trending, positively sloped line. It's not going to be very beneficial. We need to look at the 1-year percent change relative to your margins. And remember that margins are cyclical. Right? I have a 5-year chart up here. And so the idea is, how much more cost can builders pass off onto consumers? Well, they've been pretty darn successful at passing off the cost because take a look at how high these margins are. And this is a red flag. We're literally sitting at the top of a 5-year margin cycle on revenues that are more or less on a trailing basis suppressed. Okay, so this is actually good. This is counterintuitive to what most people would think because we know that the forecast here is for about a 20% improvement across the industry. So we're expecting this line to go up. However, we have a red flag warning here that these margins are already sitting at 5-year highs. Right? When I like to make an entry into a group from a macro strategy perspective, I like to see margins at all-time lows. So I would much prefer to be sitting at gross margins here, operating margins here, and net margins down here with room for much improvement. This doesn't give us much room to improve, at least over the 5-year. So now let's take a look at where we're sitting with this home builder group on a 25-year trend to see if there's opportunity longer term. Okay. Now, when I do a right mouse click and go to 25 years, I see something that's even a little bit more disturbing. And that is that we're actually sitting at 25-year high margins. Okay. And this is concerning, right? Because margin expansion is one of those fundamental catalysts that are necessary for a PE multiple expansion because it gives us additional growth on the bottom line for each dollar of revenues that come in from the income statement. And so let's take a look now at what happened here in the Great Recession, because we're going to take this all the way back to what we saw in terms of the home builder stocks actually being able to command a PE multiple expansion or a PE multiple in excess of 10 times during the Great Recession and are coming out of the Great Recession. And I'm hoping that you're starting to see a trend here, right? That we have these really, really high margins in periods of time where the PE multiple struggles to get over 10 times with home builders. We had that taking place from 1994 all the way to 2005. Take a look at how high all the margins are. And then we're struggling to get over a PE multiple of 10 now because we've got margins that are literally sitting at those all-time high levels. As a matter of fact, the margin recovery peaked here in about 2015, 2016. That's at the same time we had this massive margin rebound. So the Great Recession looks like it may have opened up quite a bit of opportunity in the home builder space because of the destruction that it did to margins. And there's always that opportunity to then improve relative to history. So again, this is looking to be a major red flag that we need to look at. Okay, so here's that period of time that I'm talking about with the Great Recession margins and the opportunity it more or less unlocked. Okay, so we're going to look here at the longer term trend in margin recovery from 2008 and beyond as a massive catalyst for PE multiple expansion beyond a 10 times for home builders. So imagine taking a position in a home builder stock with a net margin that's sitting here at -22 and riding that all the way up to basically an 11% net margin. And that's what we have across the board. So we had this multiple expansion taking place for the Homebuilder Group in aggregate because we had this massive revenue recovery coupled with a massive gross margin recovery, an operating margin recovery, and a net margin recovery. And notice that all of these tended to peak right around 2015, 2016 time period. And I've drawn the red trend lines here so you can see that. Okay. So these represent periods of time where you can get PE multiple expansion, and it's born out of this fundamental margin expansion expectation, or this opportunity for margin expansion. And when you look at where we're at right now, sitting at all-time highs, just like we were back here in 05, 06, there just isn't that much opportunity compared to what we were facing coming out of the Great Recession. Okay, so again, I'm going to take you back to that price and earnings chart, and then I've more or less clipped the chart I was just showing you, and so that you can see what was driving this PE multiple expansion. And you can see that as revenue growth began to taper, and as gross margins began to taper, and as operating margins began to taper, keep in mind this operating charge, there's actually a charge in here that if we were to adjust that out, this line would be smooth. So just keep that in mind here. But notice that as these started to taper here in 2013, 2014, 2015, so did your PE multiple. Okay. Notice that price was flat and earnings caught up. This is a PE multiple contraction until we actually ran price right into the earnings line. So we collapsed to a PE multiple of 10, and we've been there ever since. This is literally being driven by margins. Okay. So again, to kind of take you back where we're at, I've said it, I'll say it one more time. We are lacking that margin expansion potential as a key fundamental catalyst necessary for that multiple expansion beyond a 10x. So margins are already at record highs for home builders. So here's some takeaways from today's webinar. The most obvious, right? The one that everyone came into this webinar knowing is that even with years worth of pent-up demand for housing, supply side constraints coupled with expectation for rising rates, even with rates still at record lows, right? These are the most obvious headwinds for home builders. We all knew this, right? But the point that I'm trying to make in today's webinar is that we are potentially lacking margin expansion potential as a key fundamental catalyst necessary for that multiple expansion beyond 10x for home builders. We saw this coming out of the Great Recession. We just don't have this as a fundamental catalyst right now coming out of COVID. So does this mean that home builders are a bad investment right now? Absolutely not, right? What we're doing today is we're simply discussing that current home builder bid to valuation and why the buy side will not assign a PE multiple greater than 10x on a year forward EPS to the average home builder stock, right? This is the question that I have been asked by countless advisors and several portfolio managers as well, just within the last week. And so the lesson that we have to learn here comes from the income statement, right? So $1 of revenues can come into the top of the income statement, and it's the impact on EPS growth that is literally dictated by what happens at each of the gross, the operating margin, and net margin levels. Some of the best investment decisions are literally made or broken here. I've told my story of Microsoft and several other stocks that I've bought in the past at literally the bottom of their margin cycles. And that's what you want to look for. PE multiples that expand beyond 10x are largely driven by growth expectations, right? So growth expectations literally driving that multiple expansion or subsequently the contraction. Once you get over a PE multiple of 10, the rule of thumb there is that it's a really, really good indication of the buy side having confidence in management's ability to deliver on forecast growth. The higher that multiple goes, obviously the more confidence the buy side collectively has as a whole in management's ability to deliver on growth. And obviously the higher the growth, the more the award in terms of a forward multiple. What we're seeing with the home builders right now is that in the absence of this margin expansion possibility for the home builders, The buy side has more or less tempered their expectations and is literally just paying for the number of units that home builders deliver. And they're not awarding it a penny more in terms of multiple expansion on year forward expectations. So even if commodity prices back down a bit, the fact that we have margins sitting at record pre-Great Recession highs, I would expect that home builder stocks, the price of those stocks, to literally continue to walk their earnings line around a forward PE of 10x. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave me a comment below or email me at tnyland@zacks.com. You can follow me on social media, and I'm on LinkedIn. I'm also on Twitter. My handle is @TimNyland. If you're interested in getting started with an Advisor Tools or ZRS subscription, or if you're looking to upgrade your current subscription, please contact our world-class support at Advisor Tools at Zacks.com and ZRS at Zacks.com. Thank you for watching, and I'll talk to you all next week.